Welcome to video 6 of part 2 of the EA Tax Training Enrolled Agent Exam Preparation course. Tom here, back with you to discuss C corporations. Some of what you learn here will be relevant when we look at S corporations in the next video. For now, though, let's get started learning about C corps. What we will study specifically in this video are C corps in general and Form 1120, taxation of C corps, forming a corporation, distributions and liquidations, controlled groups and closely held corporations, and then we'll take a look at schedules L, M1, M2, and M3. As always, free resources from irs.gov. Here we're looking at Form 1120, which is the corporation tax return along with its instructions, and Publication 542, which covers corporations. And then we've got a couple other ones you might want to look at. Form 2220, which is the underpayment of estimated tax form along with its instructions, and the Schedule M3 along with its instructions. So talking about C corporations in general, kind of a recap of what we've said before. A C corp is a separate tax-paying entity. Profits and losses do not pass through to the owners for tax purposes. So most of the other entities we're dealing with, the owners pay tax at their own tax rate on their own tax return. If they're individuals, it would be on their 1040. But with a C corp, it pays its own taxes, so those profits and losses do not flow out to the owners. And when the corporation distributes its profits to its shareholders in the form of dividends, then those dividends are taxable to the shareholders and they are not deductible by the corporation. So this results in that double taxation of corporate profits that we've talked about so many times. A newly formed corporation is a C corp by default. If it's qualified, they can elect S corp status, but if they haven't made the election, it's a C corp. So when they go to the Secretary of State's office, form the corporation, it is by default going to be taxed as a C corporation, and it files its tax return on Form 1120. This is page 1 of the 1120. And it is several pages long. We'll look at a few of the other schedules later, but we're not going to look at the entire form in this video. So, of course, you're going to want to get that and look through it and be familiar with it. But it starts at the top with the fiscal year. If you're not a calendar year, then you put in your fiscal year, and then all the normal name, address, etc. And then it gets into the income. And remember, in the income section, it's going to include those portfolio or investment type income things, dividends, interest, etc., that are not included on page 1 of the partnership and the S corp returns. Then it gets into the deductions, and then it comes down to the bottom, and it's more like the 1040, comes to taxable income, total tax, payments, and then it lets you know what is your amount due or your overpayment and your refund due. And then we're down to the signature blocks. The filing deadline for the 1120 is the 15th day of the 4th month following the end of the tax year. So that would be April 15th for a calendar year corp. So since it is a separate taxpayer, just like an individual is, those returns are due on the same day, April 15th, at least for a calendar year corporation. Of course, many C corporations have other than a calendar year because they've got the most flexibility in choosing their year end. So many of them do choose some other month other than December for their end of the year. But of course, a lot of them are also calendar year corporations. There is the exception there. Remember, if you've got a June 30th year end, then instead of the return being due on the 15th day of the 4th month, it is due on the 15th day of the 3rd month, which is September 15th. You can always request a 6-month extension by filing Form 7004. And as with an individual, this does not extend the time to pay any tax due. It is only an extension for filing the return. Interest and penalties, if the corporation pays late, there is going to be interest charged, and then there is a penalty. So the late filing penalty is, like individuals, 5% of the unpaid tax for each month or part of a month, up to 25% total of the unpaid tax. And then there is this minimum penalty of $485 if it is more than 60 days late, unless the corporation can show good cause for why it was late. Then there's also that penalty for late payment of tax, which is 0.5% of the unpaid tax per month, up to that maximum 25% of the unpaid tax. So taxation of C Corps, the main thing is the tax rate is a flat rate of 21% on income. And of course, income is simply revenue minus expenses. And that 21% is on all types of income. So even if it is capital gain, there are no favorable capital gain rates for C Corps. So they pay a flat 21%. And then when the income is distributed out to the shareholders in the form of dividends, it is fully taxable to the shareholders, even if some of the income was not taxable to the corporation. So if the corporation has some tax-exempt income, the corporation itself will not pay that 21% tax on it. But once it gets distributed out as a dividend, there's no longer anything to distinguish between what was taxable and what was not taxable. To the shareholders, it is all taxable dividends, and so they will pay tax on all of it. The accumulated earnings tax. So because of this double taxation issue, what some corporations have thought to do is just to hold on to all their profits rather than distribute them out. If they never distribute them out to the shareholders, then you never have the double taxation issue. Or if you just wait to distribute them, you can at least delay when that second tax has to be paid. So in order to prevent companies from just hoarding their earnings and never distributing them out, and then the IRS never getting that second tax on the shareholders from the dividends, there is this rule in place called the accumulated earnings tax. And so what it says is that the corporation has to pay 20% tax on something called accumulated taxable income. And that 20% is in addition to the 21% normal income tax. So really, this 20%, it's called a tax, but it is in effect a penalty. And then when the earnings are finally distributed out to the shareholders are still going to have to pay their tax. So this really is a 20% extra tax on top of everything else. And it is 20% of something called accumulated taxable income. So what does that mean? Accumulated taxable income starts with taxable income. So that's the starting point for determining it. And then it subtracts a few things. It subtracts income tax expense because, of course, federal income tax expense is not deductible in determining taxable income, but it is an outlay that the company has. So you do subtract that. Then you subtract any disallowed deductions. So any deductions that were not tax deductible, you do subtract those. Any dividends that were paid out, you subtract those. And then you subtract something called the accumulated earnings credit. The accumulated earnings credit is the amount of earnings that are retained for the reasonable needs of the business, but then you subtract from that any capital gains for the year. So this reasonable needs, of course, is not a really black and white number. It is going to be somewhat subjective. It's based on the facts and circumstances, and as you might imagine, this is an area where corporations and the IRS often disagree, and so there's a lot of litigation around what are reasonable needs, and so therefore, how much is this accumulated earnings credit? So let's talk a little bit about reasonable needs. If the corporation can show that it has some large outlays that it is going to need to make in the foreseeable future. So, for instance, there's a large debt that's going to be coming due that they're going to have to pay off. Well, it's probably reasonable then to keep enough earnings to pay off that debt. Or if there's a large capital purchase that needs to be made, they're going to be buying a new building or opening a new location or something, or buying some large amount or dollar amount of machinery and equipment. And so they need to hold on to some of the earnings in order to pay for those things. Those would be reasonable. That's the type of things that would be reasonable needs. Now, there is a safe harbor of up to $250,000 of accumulated earnings that the IRS will automatically not consider to be excessive. So when you go through that calculation that we just talked about, taking taxable income, subtracting out those items, if the result of that calculation is $250,000 or less, then there's not going to be any issue with the accumulated earnings tax. The IRS will not argue the point. If the type of business you're in is a service type of business in the fields of health, law, engineering, architecture, accounting, etc., instead of a $250,000 safe harbor, it's $150,000. The idea here being that service types of businesses will generally have lower capital needs than other types of businesses. So the safe harbor is lower. But just as an example, let's say we have a regular type of, not a service type of business, but a different type of business. And they do their calculation and they come up with accumulated earnings of $400,000. What the IRS is likely to do is say, well, you have to pay accumulated earnings tax 20% on the difference between the $400,000 and the $250,000 safe harbor. So they would want to impose a 20% tax on the extra $150,000 or a $30,000 accumulated earnings tax. Now, of course, the corporation can argue about that and say, no, we have these reasonable needs and it's greater than $250,000. But that's where we can get into the audits and the litigation and all of those issues. But that's the basic idea. The IRS is going to say if you've got more than the safe harbor, then they're going to want to impose this 20% tax on the excess over the amount of that safe harbor. So that is the accumulated earnings tax. Next topic is the corporate alternative minimum tax. So this started in 2023. So you might look for a question on the exam about this. So this is a minimum tax on corporations with average adjusted financial statement income, or AFSI, over the last 3 years of $1 billion or more. They are the ones that are subject to this corporate AMT. The amount of the AMT is 15% of that adjusted financial statement income in excess of the AMT foreign tax credit for the year. So the adjusted financial statement income, for all practical purposes, that's book income. So these large corporations have a tension between what they report on their financial statements for book income and what they report on their tax return for taxable income. Because on their tax return, they want to report as little income as possible so they can pay the least amount of tax as possible. But on their financial statements, which are made public and which their investors see and their lenders see, they want to look as good as possible. So they want to show as much income as possible on those financial statements. So you can see they've got this tension where it's like, okay, we want to show the investors and our lenders that we're in really good financial shape, that we make a lot of money, that we've got a high net income, but we want to show the IRS that we don't make much money, that we've got a low taxable income, and therefore we pay less tax. So what the alternative minimum tax rule is saying, we're going to make sure you pay at least 15% of that book income number that you're showing to the rest of the world. So you're very proud of that book income number and how high your net income is. So we're going to make sure you pay at least 15% of that number, no matter what tactics and strategies you've used in order to lower your taxable income. So that's what the corporate alternative minimum tax is. Now, for the last few years, since 2018, so 2018 through 2022, there was no corporate AMT. But before 2018, there was a corporate alternative minimum tax. And that could sometimes result in a AMT tax credit that got carried forward to future years. So it is still possible that some of these companies could have some of that credit still available to carry forward to future years, and they can still use that for this newer alternative minimum tax. And they use Form 8827, this credit for prior year minimum tax, in order to report that. Special deductions and credits. So for the most part, corporations follow all the same rules that we've talked about for all the other businesses when it comes to reporting revenue and expenses, but there are a few items that are handled differently. So we are going to talk about each of these for a little bit. The dividends received deduction, charitable deductions, capital gains and losses, net operating loss, and this executive compensation limit. So the dividends received deduction, a C Corp can deduct, generally, a percentage of the dividends that it receives from other corporations. So it owns stock of other corporations, it receives dividends, it can deduct a percentage of those dividends. If the corp owns less than 20% of the other corporation's stock, they can deduct 50%, half of the dividends that they receive. If the C Corp owns 20% or more of the other corporation's stock, they can deduct a full 65% of the dividends that are received. If the other company is a member of the same controlled group as the C Corp, then they can deduct 100% of the dividends received. And we will talk about what a controlled group is later in this video. And for foreign dividends, if the corporation owns 10% or more of the foreign corporation's voting stock, then they can generally deduct 100% of the foreign dividends that they receive. However, that stock must have been held for at least 365 days in order for that foreign dividend deduction to be effective. There are some limitations on the dividends received deduction. There are exceptions to those that are deductible. Those are listed in Publication 542 and the instructions to Form 1120. We're not going over them here because they are not likely to be on the EA exam, but if you're interested, you can look those up. And also, the DRD is limited to either 50% or 65% of taxable income, depending on the percentage owned. And that, though, is ignoring the NOL carryover. So what this is saying is they're not going to let you wipe out most or all of your taxable income with this dividends received deduction. So they're going to limit it to either 50% or 65% of the corporation's taxable income. So you're not going to get to zero with the dividends received deduction. However, they do ignore the NOL carryover for this purpose. So if you've reduced your current year taxable income due to an NOL carryover from a previous year, when you're figuring out this limit for the dividends received deduction, you can ignore the NOL. So you don't have to reduce your taxable income by the NOL for purposes of determining this limitation. Charitable contribution deductions. A C Corp can generally deduct charitable contributions up to 10% of their taxable income. And taxable income for this purpose means taxable income without taking into account these things: the charitable contributions themselves, the dividends received deduction, any deduction for bond premium, any NOL carryback to the current year, and any capital loss carryback to the current year. So you take your taxable income, you don't take into account those things, and 10% of that amount is what you can deduct for charitable contributions. So you'll want to be generally familiar with what's not included, but the main thing to concentrate on here is the 10% number. You are going to want to know that 10% of taxable income number. For property contributions, so if you're contributing something other than cash, the amount of the contribution is its fair market value reduced by the amount that would not be long-term capital gain if it were sold at its fair market value. So that's a long-winded way of saying that if you are giving something that is not long-term capital gain property, so it's ordinary income property such as inventory. Remember, inventory, if you sell inventory, it's an ordinary gain. It's not a capital gain. Or it could be capital property, a capital gain property, but it's not long-term. You've owned it less than a year. So it's short-term capital gain. So if you donate either of those types of property, then instead of deducting the fair market value of that property, you can only deduct its adjusted basis. That's what this is saying. There is this exception. If you are giving inventory for the care of the ill, needy, or infants, then you can deduct a little bit more. You don't get to deduct the full fair market value, but you get to deduct more than your adjusted basis. You get to deduct an amount in between, halfway in between your fair market value and your adjusted basis. But for any other type of property, if it's long-term capital gain property, you get to deduct the fair market value. If it's not long-term capital gain property, you deduct the adjusted basis unless you meet this 50% rule. In any case, if you are giving property with a value over $5,000, then you have to have an appraisal of that property, and you have to be able to show that to the IRS if they ask for it. If you make contributions of food, then instead of 10% of taxable income, you can make those donations up to 15% of the corporation's taxable income. Any contributions that cannot be used in the current year can be carried forward up to 5 years as long as they do not increase in NOL carry forward. So if you've got losses, you can't increase your loss with charitable contribution deductions. But if you don't have that issue, then you can carry these contribution deductions over for 5 years. So in other words, if you make contributions in excess of 10% of your taxable income, the amounts that are in excess of the 10% can be carried forward up to 5 years. Capital gains and losses. As we said before, capital gains for a C Corp are taxed at the same 21% tax rate as any other income. There's no favorable rates for C Corps. And capital losses can only be deducted up to the amount of capital gains. There is no $3,000 net capital loss like there is for an individual who has a net capital loss. But net capital losses can be carried back 3 years and forward 5 years. But carrybacks and carry forwards are always going to be considered short-term capital losses. So that's how capital gains and losses work for C Corps. You still need to keep track of them separately, even though the tax rate is the same. Because of the way the losses work, you do need to still keep track of your capital gains and losses separately from your ordinary gains and losses. Net operating losses. A net operating loss is simply when the deductions exceed the revenue for the year. There are some special rules that apply, however. A current year NOL cannot be increased by NOL carrybacks or carryovers from other years. So you keep your NOLs separate by year. So if you have a $100,000 NOL carry forward from last year, but this year you've got a $50,000 loss again, another $50,000 NOL, you don't say, well, now I've got $150,000 NOL this year. No, you've got $150,000 NOL in total, but they're separate. It's $50,000 from this year and $100,000 from last year. As we said before, the dividends received deduction can be taken without regard to the NOL. Similarly, the deduction for dividends paid on certain preferred stock of public utilities can be taken without regard to the NOL. But the deduction for the foreign-derived intangible income is not allowed. So you do take into account the NOL for purposes of the FDII. I wouldn't worry too much about these more obscure type of exceptions here. The main thing to remember is the principles of the NOL, how it works, and the carryovers and carrybacks, which is what we're going to discuss now. So for tax years beginning after 2020, so in 2021 and forward, so that includes 2023, there's no NOL carry back allowed. So you used to be able to carry your NOL back or forward, but now you can no longer carry it back. But you still can carry it forward indefinitely. There's no limit on the number of years that you can carry it forward. There's a couple of exceptions to the carryback rule. If you've got farming losses or losses from insurance companies other than life insurance companies, then those can be carried back 2 years, and you will want to remember those exceptions. Farming losses, insurance companies other than life insurance can carry back their NOLs 2 years. Other companies cannot. And then all companies, no matter what type of business they're in, can carry forward NOLs indefinitely. An NOL carryover from a year beginning after 2017 can only be used to offset 80% of taxable income in the current year. So if the NOL was generated in 2018 or later, then you can only use it to offset 80% of current year taxable income. So if you have this year, you've got $100,000 of taxable income, and you've got $150,000 of NOL carry forwards from a previous year, you can only deduct $80,000 of that NOL this year. You can only offset 80% of this year's taxable income. And then everything else that remains, so you had $150,000, you used $80,000, so that other $70,000 then you could carry forward to future years. An NOL carryover from a year beginning in 2017 or earlier can be used to offset 100% of taxable income in the current year. And that's because these older NOLs could only be carried forward for 20 years. So there was a limit on the number of years that they could be used. And so the IRS here is saying, we're not going to cause you to possibly lose part of your NOL by limiting the amount you can take each year. So you can use 100% of it. 100% of your taxable income can be offset with those older NOLs. Executive compensation. So this is section 162M. So for publicly held companies, they cannot deduct more than $1 million per year in compensation to any senior executive officer. The senior executive officers are the CEO, Chief Executive Officer, the CFO, Chief Financial Officer, and the 3 highest paid individuals. So any of those people, if you're going to pay them more than $1 million, you cannot deduct the excess. You can only deduct $1 million. So it doesn't prohibit them from paying more than $1 million. It just says you're not going to be able to take a tax deduction for the amount in excess of $1 million. And this is not for all C corporations. This is only for publicly held companies. So publicly held companies limited to $1 million for each of these senior executives or highest paid individuals. C corporations, since they are a tax-paying entity, they need to make estimated tax payments, very similar to how individuals do. If they do not make those tax payments, they can be subject to underpayment penalties and interest. Now, the penalties do not apply if the balance due for the year is less than $500. So their estimated payments are due quarterly. It's similar to individuals, but it is not exactly the same. So you'll want to notice the difference here. So their payments are due on the 15th day of the 4th month of the tax year, the 6th, the 9th, and the 12th month of the tax year. So if we're talking about a calendar year corporation, those would be due on April 15th, June 15th, September 15th, and December 15th. If you'll remember, for individuals, theirs are due on April, June, and September 15th, but the fourth one for individuals is not due until January 15th of the next year. But for C Corps, it is due on December 15th of that year. So you will want to remember these months, the 4th, 6th, 9th, and 12th months of the year, and just remember the difference with individual quarterly payments. When they make those estimated payments, there's a couple of different methods that they can use to determine how much to pay in each quarter. There's two methods, and so we call those method 1 and method 2. So method 1 is each installment is 25% of the tax that will be shown as due on the current year tax return. So you have to do an estimate of current year taxable income, current year tax, and then you pay in 25% of that amount each quarter. And probably as you're going through the year, you're going to be fine-tuning your estimates and fine-tuning how much you are going to pay. But when you get to the end of the year, you want it to be so that you paid in approximately 25% of the total amount of your tax for the year that you're going to show on your Form 1120. Method 2 is you pay in 25% each quarter of the tax that was shown on the previous year's tax return. Now, this is only allowed if you filed a full year tax return for the previous year and if there was a positive tax liability. A large corporation, and here they define large corporation as one with at least $1 million of modified taxable income in any of the 3 prior years, they may use method 2 only for the first quarterly payment. So if you've got a large corporation, they need to use method 1. They need to estimate their taxes for the year and pay in according to what they are going to owe for the current year. Except for that first quarterly payment, they'll let you use last year's tax in order to compute that one. So they're giving you a little bit more time to get your estimates done and to get your estimates to be a little bit more accurate. Now, in addition to those two kind of standard methods, there are a couple of alternate methods. They're called the adjusted seasonal installments method and the annualized income installments method. I do not want you to get too far into the details on these. Just know what they are and the types of taxpayers that they are going to be beneficial for. So the adjusted seasonal installments method, as you might guess, is for businesses that are very seasonal, that get most or all of their income in a relatively short period of time, several months or so. So you see this here where it says can only be used if the base period percentage for any 6 consecutive months of the year is 70% or more. Don't worry about what all that means. Maybe you remember this 70% number. So the base year percentage has to be 70% or higher, but you don't have to understand exactly what that means or how to calculate it. They're not going to ask you to calculate this or anything else like that. Just know you've got something called the adjusted seasonal installments method that's good for companies whose income is very seasonal. Then you have the annualized income installments method. This is similar, but this is for those whose income may fluctuate during the year. It's not necessarily seasonal, but you've got some points of the year where you've got a lot of income and other points of the year where it's less and then some more and then less, etc. So the annualized income installments method will allow the corporation to make payments that are more aligned with those fluctuations in income. And if they want to use that, then they have to elect it by filing this Form 8842. No matter which method is used, whether it's one of these two methods or it's method 1 or method 2, The payments need to be made electronically to the IRS using the EFTPS, the Electronic Federal Tax Payment System. Forming a corporation. Capital contributions. Capital contributions, whether or not they are in exchange for shares of stock, do not result in any gain or loss to the corporation. So if the corporation's issuing stock and they're getting capital contributions in exchange, no gain. Even if they're not issuing stock, if they get a capital contribution, there is no gain to the corporation. It's not income to the corporation. It is an investment in the equity of the corporation. When a shareholder contributes cash in exchange for stock, the shareholder's basis in the stock is the amount of cash contributed. So I think that makes sense. You paid cash for the stock. Your basis is the amount of cash that you paid. When a shareholder contributes property other than cash in exchange for stock, the shareholder recognizes a gain on the exchange if the fair market value of the stock exceeds their adjusted basis in the asset that they are contributing, unless the exchange qualifies as a Section 351 non-taxable transfer. And we will talk about that here in a few minutes. The fair market value of the property is also the shareholder's basis in the stock and the corporation's basis in the asset. So you're giving a piece of property, of some sort of property, to the corporation. The fair market value of that property is going to be considered the amount you are contributing to the corporation. And to the extent that that fair market value exceeds your adjusted basis in the property, then you are going to have a gain. It's like a gain on sale of that asset. So the shareholder would have a gain on sale if they exchange that asset with a fair market value higher than their adjusted basis. And then their basis in the corporation stock will be equal to the amount of the fair market value of the property that they contributed. That does not apply if you have a Section 351 non-taxable transfer. As I said, we will talk about that shortly. It is possible for an individual to receive shares of stock in exchange for services rendered. If they do that, then the fair market value of the services they rendered are taxable to the service provider and also becomes their basis in the stock. So we'll use an example. You have a startup company. They need people to do work for them, but they are frequently short on cash. So, for instance, they may have a lot of attorney fees involved in getting the company set up. So you may have an attorney who agrees that instead of taking cash, they will take some stock in this company instead. So what that attorney has to do is they have to figure out, okay, what is the fair market value of my legal services that I rendered? So if this company went out and hired another lawyer to do all the things I did for them, how much would they have had to pay that other attorney? So that would be the fair market value of the services that this attorney rendered for this corporation. So that attorney would have to include that amount in their taxable income, just as if they had received cash. And then that amount becomes their basis of the stock. So that's an example of how that would work. So now let's talk about these Section 351 non-taxable exchanges. No gain or loss is recognized by either party if one or more persons contribute property solely in exchange for stock, if immediately after the exchange, those persons are in control of the corporation. So if 5 or fewer persons contribute assets to the corporation, and when that transaction is finished, those 5 or fewer persons are in control of the corporation, then we don't have any gain or loss. So we talked before about how if your adjusted basis is less than the fair market value of the property, then you've got a gain. No gain if those 5 or fewer persons are in control of the corporation once the exchange is complete. So a person for this purpose could be an individual human being It could also be in a trust, an estate, a partnership, an association, or even another corporation. So that's what person means in this context. Control means ownership of at least 80% of the voting power of all classes of stock of the corporation and at least 80% of the total number of shares of all non-voting stock. So C corporations can have lots of different types of stock. To be in control, these 5 or fewer persons have to own at least 80% of the voting power of all classes of stock and at least 80% of the total number of shares of all the other types of stock. So you will want to remember those rules, the 280% rules for control. These contributions have to be of property, including cash. So those contributions of services that we talked about do not qualify for a non-taxable exchange. So you will want to remember this. You are going to get a question or two on the exam about Section 351. So you will want to remember these rules. There are certain transactions that do not qualify for this non-taxable treatment. Transfers to investment companies, and investment companies is what it sounds like. It's a company that is set up primarily to hold investments. So they might hold stock in other companies or bonds, etc. So it does not apply to a transfer to an investment company. Also does not apply to transfers in bankruptcy or similar proceedings, or when stock is received in exchange for the corporation's debt. So those are the exceptions. You'll just want to make note of those. If cash or other property is received from the corporation in addition to stock, and so that's called boot, cash or other property that's received, then gain is realized by the shareholders to the extent of the boot received. So if they're not exchanging their property solely in exchange for stock in the corporation, so there's more than just stock in the corporation, maybe they're getting some cash or they're getting some other type of property, then the shareholder does need to recognize gain to the extent of that cash or other property that they are receiving. And boot in this case includes debt obligations issued by the corporation. So think about it this way. If the shareholder puts in their property, they get some stock in exchange. And in addition to the stock, the corporation basically issues them an IOU and says, okay, we owe you this much money. We'll pay you later. Then you have to treat that as if you just had received cash, and you have to recognize gain to the extent of that IOU that the corporation has given you. Some other rules for Section 351. If the property that is transferred is subject to a liability, such as a mortgage, and that liability is less than the contributor's adjusted basis, then the corporation's assumption of that liability is not going to be considered boot, and therefore it is not going to be taxable. If the liability is greater than the adjusted basis, then the contributor is going to recognize a gain to the extent of the difference. And in either case, the contributor's basis in the stock that they received is reduced by the amount of any non-taxable liability that is assumed. That's a lot of words on a page. Let's look at a couple of examples so we can understand it a little better. Bob contributes a building with a fair market value of $250,000 to Corporation R in exchange for 100% of its stock. Bob's adjusted basis in the building is $100,000, and it is subject to a mortgage of $75,000, which the corporation assumes. No gain is recognized on the exchange because Bob is in control of the corporation, and Bob's basis in the stock of the corporation is $175,000. It's the $250,000 fair market value minus the $75,000 non-taxable assumption of the mortgage. So Bob is getting out of having to pay a $75,000 mortgage, so we reduce his basis in the stock by that $75,000. Example 2, the same facts as above, except the mortgage is $125,000. So in this case, Bob must recognize a gain of $25,000, and his basis in the stock is $150,000. So he recognizes a gain of $25,000 because his adjusted basis is only $100,000, but the corporation is assuming a mortgage which is $125,000. So he has to take that $25,000 into income. And then his basis in the stock is going to be the fair market value of the building, $250,000, minus the $100,000 of mortgage that he did not have to pay tax on. So that $100,000 has been assumed, but it was not taxable. So you reduce his basis by that. So he has a $150,000 basis. So that is how that works when the corporation is assuming a liability associated with the property being contributed. Distributions and liquidations. So we talked about contributions to the corporation. Now we're going to talk about distributions from the corporation out to the shareholders. And in order to understand when we talk about dividends and liquidations and stock redemptions, we need to first understand this concept of earnings and profits, or E&P. So the purpose of computing E&P is to get as close as we can to the true economic income of the corporation. Taxable income does not usually reflect actual economic income because there are some types of income that are not taxable, so they're not included in taxable income. And there are some types of expenses that are not subtracted from taxable income because they are not tax deductible. But if you're looking at the corporation's actual economic earnings and profits, then you would include those items just because they're not included in taxable income. There still are real world income and expenses that the corporation has. So the idea of E&P is to try to get as close as we can to that actual economic number for the year. So we're looking at current year E&P. So we start with taxable income. That's our starting point. But then we're going to add some things to it. And we're going to subtract some things from it. So we're going to add to it federal income tax refunds, because remember, those are not included in taxable income, but it is actual income, money that the corporation got for the year. So we're going to add it to taxable income. Similarly, any type of tax-exempt income, we didn't include it in taxable income, but we actually did receive it. So we're going to add it back. NOL deductions, we may have reduced this year's income for carryovers of prior year NOLs, but that wasn't an actual outlay, so we're going to add those back. Non-taxable life insurance proceeds, again, adding those back. The dividends received deduction, remember, we take the deduction, but we actually did receive the dividends. So we took a deduction for 50% or 65% or what have you, but we're going to add that back for purposes of determining E&P. Capital loss carryovers, again, not a current year loss, so we'll add those back. Charitable contribution carryovers, same thing. Deferred gains from installment sales, so we sold something, but for tax purposes, we only recognized part of the gain this year, then we're going to recognize the other parts of the gain in future years, but we sold the item this year, so in effect, we should recognize all the gain this year, so that's what we do. We add those back. And then any non-taxable cancellation of debt, we add back. Then on the other side, the things that we're going to subtract, federal income taxes paid or accrued, those are not deductible for federal income tax purposes, but it was an actual outlay that we had, so we'll deduct those. Expenses of producing tax-exempt income, same thing, not deductible, but we will deduct those. And then all of these other non-deductible expenses. You can't deduct any of these things for tax purposes, but they are actual expenses that the company had, so they do reduce earnings and profits. Earnings and profits are also adjusted for depreciation. The reason we didn't include them on that prior slide is because they can be either a positive adjustment or a negative adjustment, depending on where the asset is in its useful life. So for purposes of E&P, tangible assets are depreciated straight line over the asset's ADS recovery period. So there's a couple of different concepts there. First of all, we're only using straight line depreciation. Remember, for many of the assets that we depreciate under makers, we use accelerated depreciation, either 200% declining balance or 150% declining balance, which gives you higher expenses in the earlier years of the asset's life and lower deductions in the later years of the asset's life. But it lets you deduct more of it sooner, which is a good thing from a tax standpoint. But when we're trying to figure out earnings and profits, we don't use any accelerated depreciation methods. We only use straight line. Then the second concept is this ADS recovery period. When we were talking about makers, we were using something called the GDS recovery periods. That's the general depreciation system. So remember that we had 5-year, 7-year, 10-year property, etc. That's the GDS. Well, the ADS is the alternative depreciation system. They've got different recovery periods for the different types of assets, and those recovery periods are generally longer than they are under the general depreciation system. So for purposes of E&P, we're going to use straight line depreciation only over a longer recovery period. That is going to result in less depreciation expense in the earlier years of the asset's recovery period and relatively larger amounts of depreciation in the later years of the asset's recovery period. That's why it can be either a positive adjustment or a negative adjustment for E&P, because it's going to depend on where you are in that asset's recovery period. For Section 179 expense that was claimed during the year, for those assets, no matter what class of assets those were, if we claimed 179 expense, which means we deducted the whole thing, we're going to take those assets and depreciate them straight line over 5 years. So we're just going to take the amount of 179 that we took, we're going to add that back to taxable income. Then we're going to deduct an amount equal to straight line depreciation over 5 years. So that's how we handle depreciation for E&P purposes. So why is this important? Why are we going through all these gyrations of figuring out earnings and profits? E&P determines the taxability of dividends paid. Dividends are taxable to the shareholder up to the amount of the corporation's E&P. Distributions in excess of E&P are tax-free to the shareholder up to the amount of the shareholder's basis in the stock. And then any distributions in excess of the shareholder's basis are taxable to the shareholder as a capital gain. So let's talk about this a little bit more. What do we mean here? Remember, we've talked several times about double taxation. The corporation pays a 21% tax on their profits, and then when they distribute those profits as dividends, the shareholder is going to pay income tax at their tax rate, whatever that may be. That is true as long as the corporation is distributing earnings, as long as that is what that dividend is. It is a distribution of earnings. So how do we determine whether or not the amount of the dividend that they are giving is in fact a distribution of earnings? We use earnings and profits. All of the distributions of the dividends that the corporation pays up to the amount of earnings and profits is considered a distribution of earnings and therefore is subject to this double taxation. Once the corporation has distributed all of its earnings, If it is still making distributions to the shareholders, it's not earnings that it is distributing. It is now returning that shareholder's capital back to them. So if a shareholder has contributed, let's say, $10,000 to the corporation, they get some dividends of all the earnings and profits, and now the corporation is distributing more than their earnings and profits. Well, all they're doing at that point is giving that investor part or all of their $10,000 back. They're simply giving them their money back that they contributed. Well, that's not income. Think about if you had a stock that you bought on the stock exchange and you paid $10,000 for it, and then you later sold the stock for $15,000. The first $10,000 that you get back is not taxable. All that's taxable would be the $5,000 profit that you made. So it's the same concept here. They're giving you your $10,000 back. That is not taxable income. It's a return of the capital that you put in. So that's why any distributions in excess of earnings and profit are not taxable up to the amount of your basis in the stock. So up to the amount that you have invested in that company. If then the corporation still keeps making distributions, so they've distributed all of the earnings and profits, they've given that investor all of their money back. Now, any excess is a capital gain to that shareholder because they're getting more than they invested. So they invested $10,000, they're getting more than $10,000 back. That is a capital gain. Again, similar to if they had sold the stock, the $10,000 stock for $15,000, they would have to pay a capital gain on the $5,000. The difference here is the shareholder might still own the stock at this point, depending on the circumstances. And we'll talk about the specifics of that coming up. So, types of payments that a corporation can make to its shareholders. There can be several types. So, most of them we're going to list here. There could be others that aren't on this list, but these are the major ones. So, they could be paying them wages and fringe benefits. That's one type of payment the corporation could be making to a shareholder. Could be paying them dividends. They could be redeeming the shareholder's stock. It's a stock redemption. It could be a liquidation of the corporation. For corporations going out of business and they're liquidating and returning money to the shareholder. It could be a loan from the corporation to the shareholder. The corporation could be renting property from the shareholder and paying rent. The corporation could be purchasing an asset from the shareholder. And the corporation could be reimbursing the shareholder for some expenses that they had, say, such as an employee. For the last two, if it's a purchase of an asset, we covered how that's handled back in the assets and depreciation video. So we're not going to go over that again. And if it's simply an expense reimbursement, that's just an in and an out. There's no tax effect of that. So we're not going to talk about that. But we will talk about each of these others in a little bit more detail. So first of all, wages and fringe benefits. A shareholder who works in the business receives wages just like any other employee. So they pay payroll taxes, they're subject to withholding, they get a W-2, etc. So it's different than a partner in a partnership. Remember, they do not get a paycheck, they get guaranteed payments. But if you have a corporation, you get wages and you're on payroll just like everybody else. And with a C Corp, when they receive fringe benefits, if those are tax-free fringe benefits, then they are tax-free to the shareholder employee, just like they are to all of the other employees. This is different from both partnerships and S Corps, where they have to pay tax on those fringe benefits. So for a C Corp, as long as the fringe benefits are non-taxable fringe benefits, then they are not taxable to the shareholder employee any more than they are taxable to any other employee. Reasonable compensation. The corporation does need to pay the shareholder reasonable compensation. So one strategy that could be used if we didn't have this reasonable compensation limit in place is the corporation could just pay the shareholder a very large wage in order to get around paying dividends. So in other words, instead of paying some wages and some dividends, they could just pay all of it in wages. And the reason that that would be beneficial is because the corporation can deduct any wages that they pay. So the employee, of course, is going to pay income tax, whether it's wages or whether it's dividends, they are going to pay income tax at the same rate. But the difference is the corporation gets to deduct the wages. So you eliminate the double taxation to the extent you pay wages, because the corporation now is not paying taxes on the amount of wages because they get a deduction for it. So they're not paying their 21%. So at that point, the only tax being paid is by the shareholder on the wage that they received. So the IRS knows this. So what they say is, you can't do this. You can't disguise dividends as compensation by paying some outrageously high amount of salary to the shareholder employee. Now, what is reasonable, of course, is a subject of dispute, and this ends up in court frequently because you have disagreements between the IRS and the corporation on what is reasonable pay. Reasonableness is going to depend on all the facts and circumstances. It's going to take into account the experience and skill of the employee, the duties performed, and other factors. You'd want to look at what would similar jobs pay, or what would the corporation have to pay someone else to do the same jobs that the shareholder does, and take into account all of these other things in order to determine what is reasonable pay. And then, as it says there at the bottom, it would clearly be improper to pay a shareholder who's not doing anything. So they're not actually working in the company, but they're getting paid. And when you have these small, closely held corporations, the owners might try to do that. They put their whole family on the payroll, even though nobody's actually working in the business or they're barely doing anything in the business. So any compensation that you pay has to be reasonable for what that person is doing. Otherwise, the excess could be called a dividend by the IRS, which means it is not deductible by the corporation, and the shareholder still has to include it in their income. Dividends. So another way the corporation can transfer cash or other property to a shareholder is through a dividend. So distributions to the shareholders from earnings and profits are called dividends. They are taxable to the shareholder and not deductible by the corporation, as we have already said. You can have distributions of property other than cash as a dividend. So distributions of property to a shareholder results in gain to the corporation to the extent the fair market value of the property exceeds the corporation's adjusted basis. So in other words, they're going to treat this as if you're selling the asset to the shareholder. So let's say you have a building and you're going to distribute that building out to the shareholder. The building has a fair market value of $250,000. The corporation has an adjusted basis of $100,000. When they distribute that dividend out to the owner, it's a $250,000 dividend. The corporation has to recognize a gain of $150,000 on the quote unquote sale of that building to the shareholder. And do note that the corporation cannot recognize a loss on a distribution of property to a shareholder unless it is in a complete liquidation. So we will talk about liquidations a little bit later. But other than in a complete liquidation, the corporation cannot take a loss. Again, that's one of those related party things. You can't take a loss by distributing this out to a shareholder who, of course, is a related party. There's also something called constructive dividends. So a constructive dividend is when a corporation makes a payment to a shareholder that they don't label it a dividend. It's not called a dividend, but it has the same economic effect of being a dividend. So it can be thought of as a disguised dividend. So we're going to give you a dividend, but we're going to call it something else. That's a constructive dividend. So some examples, not an exhaustive list, but some examples of constructive dividends. The corporation paying the personal or hobby expenses of a shareholder is a constructive dividend. So remember way back in the first video, we were talking about how you shouldn't commingle personal and business accounts, credit cards, etc. And you should not. But in the real world, it happens all the time. So you can have corporations where the corporation is paying the personal expenses of the owners. Of course, we're talking mostly about closely held corporations here. So sometimes you may have an owner who's got a personal credit card and they hand that credit card bill to their company bookkeeper and they say, here, pay this bill. Well, that's the personal expenses of the owner. That's not a deductible expense. So when the corporation pays that personal credit card, that is not an expense. That is a distribution to the owner. That is a dividend to the owner. Similarly, there's been court cases where owners of corporations have remodeled their entire house to the tunes of hundreds of thousands of dollars, and they've had the corporation pay all the expenses of remodeling their house. So, of course, that's a personal expense, not deductible. So if the corporation pays that, that is a dividend to the owner, which means the IRS is going to come in and disallow whatever deduction you took for paying those expenses, reclassify that as a dividend on the corporation's book so it's not deductible. And then the owner is going to have to pay tax on that plus interest and penalties, and they could end up going to prison if it is seen as being intentional and fraudulent. Hobby expenses. Sometimes corporations will pay for very expensive activities of the owners that the IRS considers hobbies. One case that comes to mind is for car racing. You have these owners who like to go out and race cars, and maybe they put the name of their company on the car or something, so they try to write that off as a marketing expense. But the IRS comes in and says, no, you're calling it marketing expense, but that's not really what it is. You're simply paying the personal expenses of the owner. They like to race cars. That's an expensive hobby. They're using their corporation to pay those expenses and get a tax deduction. But we, the IRS, are not going to allow that. So they will, again, reclassify that as a dividend, and then the owner has to pay tax on that amount, and the corporation cannot deduct it. So anytime you've got a situation where either directly or indirectly the corporation is paying the personal expenses of the owner, that is a constructive dividend. Loans to shareholders with below market interest can also be considered. The interest portion can be considered a constructive dividend. The loan portion could be too. We'll talk about that later. But here we're talking about the interest portion. So if you're not charging interest, the amount of interest that you're not charging can be considered a constructive dividend. That's what this is saying. Cancellation of shareholder debt is a constructive dividend. So the corporation loans money to the shareholder, and then the corporation says, forget about it. You don't have to pay it back. Well, that is a dividend to the shareholder. Transfers of property to a shareholder at less than fair market value. The excess of fair market value over the value actually paid by the shareholder can be a constructive dividend. So let's say the corporation owns a building that is worth $300,000 and they sell it, quote unquote, to the shareholder for $50,000. Well, the excess, that $250,000, would be a constructive dividend. You've basically just given them $250,000 worth of building for free. That's a dividend. Above market rents paid to a shareholder can be a constructive dividend. We're going to talk about rents separately, but just keep that in mind. Above market rents can be a constructive dividend. And then unreasonable compensation can be a constructive dividend, as we have already discussed. Another type of distribution that a corporation can make to a shareholder is a liquidating distribution. So when a corporation terminates, they're going out of business, ceasing to do business, that will be considered a complete liquidation of its assets. So what the corporation does here is they distribute all of their assets to their shareholders and recognize any gain or loss as if it were a sale of those assets. So when a corporation terminates, they can do a couple of different things or a mixture of things. They can sell all their assets, so they can just sell everything, convert it into cash, pay off the company's debts, and then the rest gets distributed out to the owners. So that would be kind of the clean and easy way to do it. Of course, the corporation then would have a gain or loss when they sell all those assets. So when they do their tax return, which is probably their final tax return, they are going to recognize any gain or loss from selling those assets. And then they distribute as a dividend out to the shareholders the cash. But sometimes they don't sell everything. Maybe they sell some things, and then other things, they just distribute that asset directly out to the shareholders. So maybe it's that building we've been talking about. Instead of selling the building, they just give the building out to the shareholder. So when they do that, the corporation has to recognize a gain or loss as if they had sold it. So they would look at, okay, what is the fair market value of that asset that they are distributing out to the shareholder? What's the adjusted basis? And then the corporation has a gain or loss depending on the difference. The shareholders are deemed to have sold their shares of the stock for the fair market value of the property that was received. Thereby, the shareholder is also going to have a gain or loss. So they've got a basis in their shares of stock. If the corporation's going out of business, then they're no longer going to have the stock. So they are deemed to have sold their stock for the fair market value of whatever property they are receiving. So they compare that fair market value to their basis in the stock, and then they have a gain or loss on that. The corporation cannot recognize a loss on a distribution of property to a related party, including a shareholder, if the distribution is not proportional or if the property was received by the corporation in a Section 351 non-taxable exchange within the last 5 years. So if you're doing the distributions, but you're going to give one shareholder a disproportionate amount of assets, then the corporation cannot recognize a loss when they distribute that asset. Or if the corporation just got the asset within the last 5 years in a non-taxable exchange, then the corporation cannot recognize a loss. This is to keep people, again, from playing games where they know the corporation's going to go out of business. They contribute property in a Section 351 exchange, which is non-taxable, and then take a loss when they distribute that property back out. So the IRS is saying, no, you can't do that. So we're going to put this 5-year rule in here that says if you contributed that in a non-taxable exchange within the last 5 years, then the corporation cannot take that loss. If the corporation is doing a liquidating distribution, they must file this Form 966 within 30 days of adopting a plan to dissolve and liquidate. And the corporation has to issue a Form 1099 div to any shareholder who receives $600 or more in the liquidation. So what the combination of these two things is doing is letting the IRS know that this corporation is liquidating. So now the IRS knows what's going on when these shareholders get these 1099 divs. Stock redemption. A stock redemption is when a corporation buys shares back from a shareholder. So this differs from a liquidation because the corporation is going to continue to exist. So the stockholder is going to get some money from the corporation, But what the corporation is doing is buying part or all of their shares back. And then the corporation is going to keep on doing business as usual. So in general, this redemption is going to result in a capital gain to the shareholder. So you're going to be treated as if you sold the stock, because in essence, you did sell the stock. You sold it back to the corporation that issued it. So you've got a capital gain or loss, depending on your basis in that stock. And the purchase of the stock is not deductible by the corporation. So it's just like if they had invested in some other corporation stock, that's not a deduction. It just so happens that the stock that they are purchasing is a stock in themselves. It's their own stock, but that is not a tax deduction. That is simply a reduction in the equity of the corporation, not a tax deduction. In certain cases, a redemption can be reclassified as a dividend rather than as a redemption, thereby resulting in ordinary income rather than capital gain to the shareholder. So, for example, if the redemption is made proportionally to all shareholders and does not reduce their percentage of ownership, it will be treated as a dividend. So, example here. Corporation X has 1,500 shares of stock outstanding. They are owned 500 each by shareholders A, B, and C. Corporation X now redeems half of the shares, 250 from each shareholder. So A, B, and C now own 250 shares each, and there are 750 shares outstanding. Well, the ownership percentages have not changed. Before the redemption, each shareholder owned 1/3 of the total company. After the redemption, each shareholder still owns 1/3 of the total company. So this, the IRS says, will not be treated as a redemption. It will be treated as a dividend. So this is in order to prevent companies from trying to convert ordinary income into capital gain. They say, okay, if we give ourselves a dividend, we're going to have to pay ordinary income tax on that. But if we simply redeem some of our stock, that's a capital gain. Well, that doesn't work. If everything is the same before as it was after, as far as ownership percentages goes, then that redemption will effectively be ignored, and that will be considered a dividend and taxed at ordinary tax rates. Sometimes a stock redemption might be a partial liquidation. So the corporation is not completely liquidating and going out of business, but they have decided to liquidate some part of their business, some part of their assets, and then they are going to do a stock redemption. They're going to use the proceeds in order to redeem some of the stock. So this type of partial liquidation will simply be treated as a regular stock redemption rather than as being a dividend for all non-corporate shareholders. So if the shareholder is another corporation, that will be considered a dividend. But if the shareholder is not a corporation, it will be treated like any other stock redemption, and then that shareholder will have a capital gain or loss upon that redemption. Loans to shareholders. So another way to get money from a corporation to a shareholder is by the corporation making a loan to the shareholder, and that's fine. That is allowed. However, it needs to be a bona fide loan, an actual loan. There should be a written loan agreement, like we've talked about before when you're talking about related party transactions. You want to use market interest rates because remember, below market rates can result in a constructive dividend, like we said before. You want to make sure that the corporate form is maintained. So, for example, the loan might have to be approved by the board of directors. So you'd want to do that. You'd want to have all the documentation in place. And the risk of not following all of these processes is that the IRS could step in and say that the entire loan is not really a loan, but it's a dividend. So if it doesn't look like a loan, and if you're not actually treating it as if it's a loan, so there's no actual loan there, then the IRS is going to say that's not a loan, that's a dividend, and they're just going to call it that and tax it that way. So the shareholders will be taxed on that as if it were a dividend. Rent paid to shareholders. A shareholder can rent property to the corporation. That is perfectly acceptable, happens all the time. In some cases, it can be a good tax planning strategy. So it is legitimate to do that. However, as always, when dealing with related parties, rents should be at market rates because remember, above market rates can result in a constructive dividend. So let's say that you've got a building that the owner owns and is renting to the corporation. And let's say that the fair market value rent on that building is $3,000 a month. And the corporation and the shareholder enter into an agreement for the corporation to pay $7,000 a month for that building. Well, that excess $4,000 a month would be reclassified as a dividend because even though you're calling it rent, really that extra $4,000 is not rent, that's a dividend. And again, this is similar to the compensation. The reason the corporation would do this is because rent is tax deductible and dividends are not. So if you can just pay some extra rent, then the corporation gets a deduction for that. So the corporation is not paying that 21% tax on it. The owner, of course, is still going to pay tax on the rental income, but they would pay tax if it was a dividend as well. So it's the same for them. So above market rent can result in a constructive dividend. And any rental agreement you have should be in writing. Again, it should follow the corporate form, being approved by the board, etc. And you want to make sure that both parties are following the rental agreement. So you've got a rental agreement, it's got certain terms about when rent should be paid, etc. Make sure that both parties are following the agreement. And this allows the corporation to go ahead and deduct the rent payments. And then the shareholder, of course, includes the rent and income, but they can also take deductions for related expenses. So they've got a rental property. They can take all the normal rental property deductions, depreciation, taxes, maintenance, etc. So this can work out well as a tax planning tool in certain cases, but you want to make sure that you've got everything in place to make sure that it is legit. Next topic is controlled groups and closely held corporations. Controlled groups. Sometimes taxpayers and their advisors will try to lower the overall taxes that are paid by a business by splitting the business into separate corporations. Then they can shift money and profits between those corporations to try to minimize the amount of tax paid. They might have service agreements between corporations or rental agreements or management agreements and these types of things between the corporations, shifting the money around, lowering their tax when the economic reality is it's really just one business. So what the IRS says is if you're going to try to do this, you're going to try to separate out into these separate corporations. We're not going to let you get away with that. We're going to treat, you can go ahead and do that. You can separate out as many corporations as you want. However, if you meet certain tests, you will be considered a controlled group of corporations. And so you'll be considered all one big taxpayer. That's what this is doing. And there are three basic kinds of controlled groups: parent subsidiary group, brother sister group, and combined group. So we will talk about each of those. I will warn you, this is one of those areas that in the real world can get very complicated. I mean, you get dealing with large corporations and multinational corporations, and then you've got all of these different corporations and subsidiaries. Extremely complex, but the enrolled agent exam is not going to test you on that. They're going to test you on the basic concepts. So I'm going to encourage you to not get too far into the weeds here. Just look at the basic idea, understand the basic concepts, and then move on with your studying. So let's talk about these different types of groups. Parent subsidiary group, this is probably the one that's the most familiar. This is when a parent company owns, directly or indirectly, 80% or more of another entity. So Corporation A owns Corporation B. Corporation B is a subsidiary of Corporation A, and so they must file a consolidated income tax return. Next is a brother-sister group, and that is a group when two tests are met. The same 5 or fewer individuals own 80% or more of each company under consideration, and the same 5 or fewer individuals have identical ownership of more than 50% of that company. So again, don't get too far into the weeds of trying to think of all the different scenarios. Just remember these rules, the 80% rule, the 50% rule. Same 5 or fewer individuals own 80% or more of each company, and they have identical ownership of more than 50% of each company. So if we think of a parent subsidiary as parent-child, here we're talking about brother-sister. So they are the common child of some parent, owner. That's what this is saying. They are brothers and sisters rather than parent and child. So that's the second kind of controlled group. Then we have something called a combined group. If all you had was the parent subsidiary and the brother sister, there would be ways that you could arrange things so that you don't quite meet the test for parent subsidiary, you don't quite meet the test for brother sister, but in effect, it's still a controlled group. So the purpose of the combined group is to try to close those gaps, to close those loopholes. So what this says is if you've got 3 or more corporations and each of them is a member of either a parent subsidiary group or a brother sister group, so 3 corporations, each of which a member of either a parent subsidiary or a brother sister control group, or both, but at least one of the two, and at least one of those 3 corporations is both the common parent of a parent subsidiary control group and a member of a brother sister group. So it's combined parent subsidiary and brother sister. So again, don't burden yourself with trying to think of all the permutations and combinations. Just remember the rules. 3 or more corporations, each of them is a member of either a parent sub or a brother sister group, and at least one of those 3 is both a common parent and a member of a brother sister control group. Those are the rules for a combined group. Next, closely held corporations. We actually talked about this in a different video when we talked about at-risk limits, but we'll go over it again because it is a C Corp concept. A closely held corporation is one where at any time in the last half of the tax year, more than 50% of the value of the stock is owned by 5 or fewer individuals. That is a closely held corporation. The reason that is important is because the at-risk limits apply to closely held corporations. So losses are only allowed up to the amount of the taxpayer's risk of financial loss, but these at-risk limits do not apply to non-closely held corporations. Schedules L, M1, M2, and M3. If you were with us on the partnership video, then this is going to be very similar because they have similar schedules in place. So we're going to look at these for the C Corp. Schedule L is the balance sheet, just like it is on all of these entities. Anytime you hear Schedule L, think balance sheet. And then Schedule M1 is a reconciliation of book and tax income, just like it is on the other entities. Schedule M1 for corporations is only used for corporations with less than $10 million of assets, which is a similar rule that we saw with partnerships, but it is a little different, as we'll see. Schedule M2 is a reconciliation of beginning and ending retained earnings. So with a partnership, it was a reconciliation of the capital account, but it's the same concept here. It's a reconciliation of retained earnings. And then Schedule M3 is a separate form that's for reconciling book and tax income for corporations with $10 million or more in assets. So this is an overview of Schedule L, M1, and M2. So you've got the balance sheet on the top. We'll look at this in a little bit more detail here in a minute. Then you've got the reconciliation of book and tax income, that's Schedule M1. And then you've got the analysis of retained earnings there in Schedule M2. So looking more specifically at the balance sheet, again, very much like we saw with partnerships, you're going to start with your assets. You've got beginning of year and end of year that you're going to put those in. You're going to come down, see all of your assets. Then you're going to get into liabilities and shareholders' equity. And this is where it looks a little bit different. So on the partnership balance sheet, equity section was one line, capital accounts. Well, on the corporate balance sheet, equity is lines 22 through 27. So what's that? 6 lines for the equity section. So here you've got preferred stock. It's called capital stock. So it's preferred stock and common stock. This is where you're going to put what's called the par value of the stock. So when the stock is issued, it has a listed value on it. It's usually something like $1. So the capital stock will show what is the par value of all the stock that's outstanding. Then you've got additional paid in capital. So that's amounts that have been paid in above and beyond the par value of the stock. Then you have retained earnings, which is broken down into appropriated and unappropriated retained earnings. Appropriated retained earnings is when the board of directors of the corporation has said, we need to set aside a certain amount of the earnings to pay for some specific thing or things. And so we're going to appropriate those retained earnings, which means those retained earnings are not available to be distributed as dividends. So then unappropriated retained earnings is all the rest of the retained earnings. They have not been set aside and they can be distributed as dividends. Do not confuse retained earnings, either appropriated or unappropriated, with cash in the bank. It is not cash in the bank. Any cash that the corporation has is going to be listed up in the cash section of the assets portion of the balance sheet. Retained earnings is an accounting concept. It's not cash. So when we say these earnings are quote unquote retained, it simply means that they haven't been counted as an expense and they haven't been distributed as a dividend. It doesn't necessarily mean that we've got the cash in the bank. So just don't confuse those two. I just want to make sure that we understand retained earnings is an accounting concept, not a cash concept. Then you've got adjustments to shareholders' equity. So that kind of picks up any miscellaneous types of adjustments that you may have had. And then less the cost of treasury stock. So what is treasury stock? Well, remember we talked about stock redemptions, which is when the corporation buys back its own stock. So when it does that, that is called treasury stock. So it is actually a reduction to owner's equity. So treasury stock is the corporation's own stock that it has purchased back from shareholders. And then it totals up the total of the liabilities and shareholders of equity, which of course will equal the total assets. M1, this is the reconciliation of book income and tax income. So you're going to start with your income or loss per books, and then you're going to make whatever adjustments there are. You're going to add some items, you're going to subtract some items, the book to tax differences that we have discussed before, and then that is going to end with taxable income. So you are reconciling, you're showing we started with this much income per our books, maybe per GAAP accounting. It doesn't have to be GAAP accounting, but as an example, here was our income per generally accepted accounting principles. Here's all the differences between book and tax. And now here is our taxable income. That's what Schedule M1 is doing. And then Schedule M2 is the analysis of unappropriated retained earnings. So we say what was our retained earnings at the beginning of the year, what adjustments have been made. So income increases retained earnings, losses decrease it. There can be other increases as well. Distributions, when you make distributions out of earnings and profits, you are reducing retained earnings. So you would show those here. There could be other decreases, and then you will end up with end of year retained earnings. And so we should see these numbers back on Schedule L. You'll have last year. Remember, you show last year and current year on Schedule L. So you would have last year's retained earnings would be the beginning balance, and then this year's retained earnings would be the ending balance. Now, these schedules that we've just gone over, schedules L, M1, and M2, are not required, similar to the partnership, they are not required for quote unquote small corporations. Now, the definition is a little different for corporation than it was for partnership. So for a corporation, if they've got less than $250,000 of gross receipts and less than $250,000 of assets, so less than $250,000 of both of those, then they are not required to file Schedules L, M1, and M2, and of course, not M3 either. If they're not required to file them, if they made any type of distributions during the year, any type of dividends, then they do have to enter the amount of those distributions on a line on Schedule K. So we'll look at that here briefly. And of course, these schedules can still be completed even though they're not required. And I will just tell you, especially for a corporation, I like to always have these schedules done. But for the exam, you need to know that for these smaller corporations, you do not need to file these schedules. So here's that part of Schedule K where you put in the distributions. You put it right here. Well, first, you're going to answer the question, are the corporation's total receipts for the year less than $250,000 and total assets? Then you're going to say yes. So it says if yes, then you're not required to complete those schedules. So fill in the amount of the distributions here. If you go ahead and file those schedules anyway, even though you're not required to, you don't have to fill it in here. But this is assuming that you're not going to do that, so you have to put in the distributions here. And you can see this is just one part of Schedule K. Schedule K on the C Corp return is mostly just a bunch of check boxes. I encourage you to go ahead and look at it at your leisure, but we're not going to look at all of it now. Schedule M3. Corporations must file Schedule M3 if they have total assets at the end of the year of $10 million or more. So remember from the partnership return, and we'll look at this one again here for the corporation return, but Schedule M3 is the much more detailed reconciliation of book and tax income. And the rules are more straightforward here than they were for the partnership. Remember, for the partnership, it's like if you had assets of 10 million or more, or adjusted assets, or revenue of a certain amount, then you had to file M3. With the corporation, it's easier. It's $10 million or more of assets at the end of the year. That is the test. If you had that, you have to file Schedule M3. And when we're looking at total assets, you consider all of the assets if you got a consolidated group. Remember, we treat them as one big taxpayer. So we're going to look at all of their assets to decide whether or not they need to file this Schedule M3. And if the corporation is required to file Schedule M3, then they must also file Schedule B, which is additional information for Schedule M3 filers. Remember, for partnerships, this was called Schedule C of 1065, but for corporations, it is Schedule B of Form 1120. Corporations with $50 million or more of assets must file Schedule M3 in its entirety, again, similar to the partnership rule. Corporations with between 10 million and 50 million of assets can opt to complete only Part 1 of the Schedule M3 and then to go ahead and file Schedule M1 instead of filing Parts 2 and 3 of the M3. And if they do that, then they're also not required to file that Schedule B. So 50 million or more of assets, got to file the whole thing, all of M3. 10 million to 50 million, if you want to, you can just fill out Part 1 of the M3 and then go ahead and fill out Schedule M1. And of course, any corporation can go ahead and choose to file the M3, even if they're not required to. But if they do, then they have to follow these rules. So let's look at the M3 real quick. So it starts with basic information and then some check boxes of the things that they're asking. And then it gets into your book income. So you're going to have to show here in detail your book income. So that is part 1 of the M3. Then we're going to get to part 2. And part 2 is where you start the reconciliation of net income to taxable income, but it is specifically income items only. So part 2 is just showing all the book and tax differences for income items. And then part 3 shows all of the book and tax differences for expense items. So again, it is a much more detailed look at the differences between book and tax income. And then Schedule B, which is the additional information. This is a series of check boxes where you're going to say yes or no, whether or not you have any of these things. So this is in order to give the IRS some idea of things that they might want to look at in case of an audit. So that is going to do it for video 6. So when you're going through this, if you can go back through the video, if you're looking at the slides, concentrate on, again, the big concepts, the big ideas, especially the contributions to corporations and the distributions from the corporations. You're going to get questions on that. They want to make sure you understand things like the non-taxable 351 exchange, for example, and the taxable dividends and how stock redemptions work. So want to make sure that you have those big concepts. Go over it a few times. Make sure you understand those ideas, and you should be fine for the EA exam. On video 7, we're going to talk about S corporations. So I will see you then.